This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 293, and this week we are talking again for the first time in, a year and a half, Ben, talking about Bitcoin and the news, the recent news. After a whole lot of back and forth and a whole lot of drama, the U.S. Securities and Exchange Commission permitted 10 spot Bitcoin ETFs to begin trading a few weeks ago. And this is pretty big news, so we thought there's some lessons in this. So we reached out to someone who we've both followed for a long time, Eric Balchunas. So Eric joined us today. Eric's a senior ETF analyst at Bloomberg Intelligence, where he does research and articles and feature stories about ETFs for the Bloomberg Terminal and also Bloomberg.com. He is host of the podcast Trillions. He is also the author of the 2022 book, The Bogle Effect, How John Bogle and Vanguard Turned Wall Street Inside Out and Saved Investors Trillions. It's pretty fun to meet Eric after following him, and we've mentioned him many times on this podcast. But with that, Ben, why don't you give us your perspective, especially given all the research you did in 2022 on Bitcoin and crypto in general?
Yeah, I mean, Bitcoin has gone mainstream now, I think officially. If it's trading spot, Bitcoin ETFs are trading. We saw the flows that have gone into them, which we talked to Eric about. One of the questions that I asked Eric, which I think is pretty interesting to think about, and so does he based on his answer, is how does this affect Bitcoin's identity? Because Bitcoin, its conception was this ideologically motivated currency outside the reach of regulations and governments. Like if you read the original paper, that was its purpose, and now it's trading on regulated exchanges, and you've got people like BlackRock and BlackRock's leadership talking about why Bitcoin is good to invest in. So that's very different from, I think, what Satoshi Nakamoto had intended, or that group had intended, whatever it was, when they came up with the idea, when they wrote the original paper and coded it. So, yeah, I mean, it's an interesting evolution for Bitcoin. It's also interesting that we've had spot Bitcoin ETFs in Canada for quite a while now. Mm-hmm. So while this is a big deal in the U.S., it's less so in Canada, and I don't know. I think a lot of people, Bitcoin pumpers, thought that there'd be a big price increase if this happened. That has not happened. Price has gone down. Eric thinks, based on our conversation, that long term it'll have a positive price impact, which, I mean, makes sense if it increases access.
Interest. Yep.
Yeah, and interest. I don't know. Great conversation. I mean, Eric has got, he called himself a tourist in crypto, but he's got deep expertise in ETFs, and that's really where we focus the conversation. So a really, really interesting conversation.
I was just going to say, Ben, even if you're not a crypto, have any interest in crypto, Eric's explanation of creation and redemption and some of the nuts and bolts and the plumbing around ETFs, he is a very good communicator. So if nothing else, you'll learn about the ETF features and how they actually operate.
Well, this is the thing. We had to do a crypto series because we heard from our audience that they didn't want to hear about crypto. We got very strong feedback. We did a couple episodes on crypto.
Yes.
But I wanted to explore it, so we did a separate series. But now Bitcoin's trading on the exchanges in ETFs, which again isn't that new, but being in the U.S. and being a spot ETF instead of a futures ETF, I think makes it that much more mainstream. But like you said, we could have had this conversation just about the mechanics of ETFs, and it would have been almost as interesting. Yeah. But with the addition of talking about the relationship between that and Bitcoin, I think makes it a really unique conversation.
Yeah. He was awesome. Okay, let's go to our conversation with Eric Balchunas.
Eric Balchunas, welcome to the Rational Reminder Podcast.
Great to be with you guys.
Great to have you here. Eric, why was Canada there's all this news about the spot Bitcoin ETF in the U.S., but Canada's had this for like a while now. Why was Canada so far ahead?
You guys have liberal regulators. I don't know why exactly, but Canada has been famous for getting products out quicker. The first ETF ever launched actually came out of Canada very quickly. My first book, I researched this heavily. I talked to the guy from the American Stock Exchange, Steve Bloom, and he said, we had Toronto down here, and we showed them our design for SPY, and they went up and did something similar, but they only had to wait a year. We had to wait 4 years. So Canada has this history of just getting out early, whether it's the first bond ETF, the first ETF, obviously, and then the first cannabis ETF you also had first. There's a couple other ones. I'd have to go back, but it's not a shocker that you had spot Bitcoin before us too. So it's just the way it is. I think if anything, maybe you guys, just because there's just not, it's a bigger market down here. There's more CYA, a lot of investors are like do-it-yourselfers, so they can buy anything. They know how to get their hands on stuff. I don't know if everybody in Canada is rushing out to get the latest thing, but here you put something on the market in an ETF and grandma can get it. So they have to be careful, but in this case there's probably a little politics involved. So that would be my reasoning. Now, why your regulators are a little more liberal, I don't know, but I identify with that. I think sometimes you just want to put disclosures in there and let the people choose. And I think they should have approved it years ago.
That's really interesting. And why did the spot Bitcoin ETFs take so much longer to be approved by the SEC than the Bitcoin futures ETFs?
Yeah, they shouldn't have, to be honest with you. But the answer was really that the futures ETF the futures are regulated by the CFTC. And so Gensler had comfort knowing that the thing it holds is regulated. Spot Bitcoin, the Bitcoin way out there, he thought was the Wild West. So if you do a spot Bitcoin, you're holding something that he thought was Wild West. Whereas the futures were controlled. And everybody knows the futures are riffing off of the Wild West, and that's what the court found to be inconsistent, and that's why they lost in court. So that was the reasoning for him to approve futures and not spot. But if you really think about it, that doesn't make much sense. But look, he's a Democrat, and he generally more into regulation. He's also a lawyer, and I think that's really what was behind it.
He's pretty sharp on crypto too, right?
Yeah, no, he taught an MIT class on it, and when I first saw he got appointed, I went and Googled his feelings on this, and I watched some of the class. It was really good. He knew his stuff. It seemed like he was even into it. Now, I don't know if that changes once you become SEC chairman. He probably has meetings with Elizabeth Warren, and all of a sudden, his tune changes. I guess that's probably what went on there. Maybe after he gets out, he can give an honest interview and tell everybody what went on in his brain. That would be very interesting to hear. The other guy who was just on there last, I believe his name's Jay Clayton. After he left, he went to a firm that had some stuff to do with the crypto industry. And so I think that is the same deal. I think when you put the SEC chairman hat on, there's just got to be other pressures that we don't see that I kind of have some empathy for. So he may in his heart say, this is fine, but as this person wearing this hat, I have to have this other view.
Yeah, that's interesting. Yeah, I watched all of his crypto lectures, and I agree. He gets it, and it did seem like he was into it. Has anything actually changed in ETF regulations to allow a spot Bitcoin ETF?
No. No, the only thing that changed was that the SEC got sued and lost. They found that the decision to not allow spot and allow futures was arbitrary and capricious. And 2 of the judges of the 3 were Democrats. That was a big deal. So when they 3-0 was the vote. And when you lose Democrat judges, okay, that's clearly an issue they probably overstepped on. So that was it. Now, there's other theories on Gary could have went out and said, well, let's make custody the new issue. And he probably could have prolonged this. I think he had some opening there. Not a lot, but he could have done it. You could argue the PR and everything was more politically untenable after the court loss, but he could have done it. But BlackRock filed, and Fidelity filed. And I'm wondering, I sometimes think those firms being in the mix may have given him some peace of mind that, hey, this isn't just Grayscale. There's a lot of other firms, a lot of firms that we can trust and that know what they're doing. Maybe that gave him some comfort and peace of mind that, okay, I'll just do it because I trust these firms. That's what I would have thought if I were him. But we'll never know, because what's weird is they did the vote and it was 3-2, but Gary was the deciding, because there's 2 Republicans they voted to approve. In the past, Gary was with the other 2 Democrats, but Gary was the one who went over. And Elizabeth Warren immediately came out and tweeted like this nasty tweet about how she hates the spot Bitcoin ETFs. And that's interesting. So Gary looks like he was stood up for what should happen and listened to the courts. And maybe BlackRock being involved helped all that. I have to think it might have factored in. But at the end of the day, if they don't lose that court case to Grayscale, I just don't think this happens. Or it doesn't happen in this cycle.
So I have a bit of a ETF plumbing question for you. What does it mean that the SEC only approved cash creations and redemptions?
Yeah, let me give you just real quick. Do you like ETFs? To me, are my whole being, right?
Yeah.
So I've had to teach classes on them, and when it comes to creation redemption, I used to get scored negatively in that section because it was boring. They didn't understand. So I explain it just by giving you where the idea came from. The guy who started the ETF is named Nate Most. He used to be the president of the Pacific Commodities Exchange. So he was familiar with this thing called commodities warehouses, where a bunch of commodities would be stored. And so, for example, soybean oil. You take a bunch of soybean oil to the warehouse. You store it in a locker. They give you receipts. And you can trade the receipts with other commodities people. So they're always trading receipts because it's easier than moving the merchandise around, right? Makes sense? So he thought, well, if we're going to do this market basket instrument, a way to keep the cost of trading away from the investors in the fund, why don't we use this commodity warehouse concept? And instead of soybean oil, we'll use the S&P 500 stocks. So when you get a bunch of receipts and you want your oil or your stocks back, you take them in and you get it back. That's an in-kind transaction. You're giving me soybean oil for the receipts or the receipts for the soybean oil. Cash just means that you give cash for the receipts, and the person running the locker goes and buys the soybean oil and puts it in there for you. That's the only difference. But everything else is still the same, and the key point there is receipts. The receipts are connected to a proportional section of what's in that locker. It could be in soybean oil. In this case, it's Bitcoin, but it could be S&P 500 stocks. And so the first ETF ever had the acronym SPIDER, S&P Depository Receipts. So it's still a receipt. It's the same deal. It's just instead of handing them soybean oil, you would hand them cash to get the receipt, and then the locker would go immediately purchase soybean oil, put it in the locker, and your receipts it's the same deal. So the end investors is still receipts, the same thing. It's just who bought the soybean oil. And so that's the difference. That's it. The reason the SEC wanted cash only was in that example I just used. The people who are interacting with the custodian, the locker, so to speak, they didn't want them touching Bitcoin. They wanted the Bitcoin transaction controlled just between the issuer, the custodian, and the Bitcoin. That way they wouldn't get any Bitcoin that was used for money laundering or any they could isolate who was touching the Bitcoin. Whereas the first system I mentioned, the in-kind, any of these APs and market makers could end up gathering the Bitcoin, the soybean oil, and presenting it. That leaves a lot of openness to where the Bitcoin comes from.
Did your score in teaching that class improve when you started teaching it that way?
Yes.
Because that was pretty good.
That was pretty good, Eric.
People like the visual of a big warehouse.
Yeah.
And it makes sense. And once they lock into that visual, creation redemption became a lot easier.
Yeah.
Yeah. So related to that, are the spot Bitcoin ETF units backed by actual Bitcoin? Is there gold in the vault?
Yeah. Yes. I mean, they have to have it in there. I mean, it's in their prospectus. The other thing, these companies, there's 2 other things here, which is they don't want to be long or short Bitcoin. They are not in that business. They are not trading. They want to be flat and take a little fee. They're like a vigorish at a casino. They're not in the gambling business. Sands doesn't gamble. They just want to have both sides play each other, take a little bit. So they have no invested interest to, like, I don't know, not have the Bitcoin. The other thing is, these companies have, a lot of them have hundreds of ETFs, hundreds of mutual funds. They've been around for 40, 50 years. They don't want to mess with their brand over like an ETF that might be $10, $15 billion. They have trillions in assets. This is not worth it. So there's multiple reasons why this would never happen. And so in the gold case, there's always people who don't believe it. They sometimes take someone to the vault, but I guess they could take them to gold bars that aren't really, like, at the end of the day, you could lie, but the reason that the motivation to lie is so not there. It just doesn't. They'd get sued immediately. There'd be all kinds of repercussions, and these are companies that have a ton of money. So of course, suing them would be great. You can definitely clean up. FTX was the reason ETFs are so good is because you don't have a SBF problem ever. That's why that locker situation is really great, because let's say Larry Fink lost his mind, or we didn't know that BlackRock was going bankrupt. That BlackRock could go bankrupt. Those receipts would still translate to that custodian. That's called being transferable, and so ETFs are kind of SBF proof, and which is why we wanted them approved from the beginning. But furthermore, Larry Fink just doesn't have the same brain as a young SBF. Different mindsets, and so in a way, the adults are here. This is an adult operation, very serious. So I try to tell people you have nothing to worry about. Now they say, well, what about the government confiscating the Bitcoin? Now that's a whole different story. Would BlackRock work with the government? Maybe. And that I get. And Goldbugs used to bring up FDR confiscating the gold in the 20s. And to that I say, well, you should own your own Bitcoin then. This ETF is not for you. You're at another level. And certain gold bugs are like that too. They should own a gold, get a safe, store it. There's even a gold ETF actually that stores the Bitcoin in Switzerland to appeal to the people who are worried about the U.S. and the West doing that. So we could have some kind of an alternative storage facility for Bitcoin. But at the end of the day, if you're that, I wouldn't say paranoid because it did happen, but if you're that worried, you should just get your own Bitcoin. No problem there. And I'm an ETF. I'm obviously a big ETF advocate, but I'd be like, just do it yourself.
Do it yourself. Hold the Bitcoin and make sure you have sufficient weapons to defend yourself when they come to confiscate it.
Yeah, and this brings up the two cases for Bitcoin, right? One is the government is not to be trusted. The currencies are going to hell, and we could end up in like a Mad Max post-apocalyptic thing where there's dirt roads and whoever has Bitcoin actually can get goods and services. In that scenario, you got to own the Bitcoin, because that's the whole point. The other case is that, hey, it's just this cool new digital gold. It's a store of value, and it will help diversify and add some returns to your portfolio. That is, you just use the fund or the ETF. There's no worries there. So it depends on where you're coming from, which makes this such an interesting asset class, because you could go from, hey, it's cool, to like literally Mad Max and everything in between. And the more you get to Mad Max, the more you have to buy it, because otherwise, if we end up in some kind of Mad Max world, the Bitcoin itself would be needed for this as the currency. But in a store of value world where society remains fine, it doesn't matter. Just use the ETF. Who cares? It's a pain to store it. Just outsource it.
Yeah, and don't lose your keys in the Mad Max version.
Don't you? Yeah. Well, that's another thing is the whole remembering a bunch of these. You got to remember a bunch of words your whole life. I can't remember my Amazon password. So when I use a new device and they ask, I can't remember it. I got to change it again, and I want no part of that. So I'd be the perfect. Hey, BlackRock, you can do it. I'll give you 25 basis points a year. Happy to do that. In general, fund investors overall they like to outsource. They don't want to deal with this, and that could be Bitcoin or the S&P 500 stocks, or small caps or China stocks. They want one ticker, and they want all that in one shot.
Yep. So you mentioned trust and reputation of the issuer. in terms of how people can be sure there's Bitcoin in the vault, so to speak. Is there any way, like, are any of the funds posting their wallet addresses or anything like that?
One has Bitwise. I imagine we could see some more, but Bitwise is probably one of the most progressive and into crypto of these firms. I don't know if BlackRock. First of all, they don't need to.
Right? Yeah, they don't.
If they're going to lose a couple hardcore people who need the address, they don't care. Bitwise is a little more of a smaller issuer, so they're looking for edge, and so this is a cool way for them to like sort of say, look, we're not afraid. We understand this. So if you're like really into crypto, Bitwise may appeal to you because of that. They also like donate some to developers. VanEck's a little like that too. So yeah, there's one example, and they've already gotten tips or just people sending them random Bitcoin, which is interesting because it's possible we could get into a world where, I don't know, say the ETF has a good year and they all consider themselves part of a community. Maybe they just throw in an extra like, $1,000 into the kitty, and everybody throws in a collective $1 million, and they're able to actually offset the expense ratio because that money would just go right into the NAV, and in a way it would basically kill the fee. So it would be like a rebate. So you could have people who's like, let's all use Bitwise, we'll all put in a little. But then again, you could also argue, don't put in anything, we're going to pay for the fee anyway. We'll consider that our donation. So anyway, it's kind of funny. It's to think about that you could tip an ETF, because in the old ETF, there's no way you could do this. Right. You need an AP. Here, the idea that some random person can like put Bitcoin in the fund is really interesting. It's weird.
Yeah, that is. Hey, could that lead, like with ordinals, for example, could that lead to any kind of sabotage?
Good question. I'm gonna say that's just a little beyond my depths in terms of this. This is where I'm like, well, look, Bitwise is smart. They know what they're doing. I would defer to them on that, and that's where I think the trust comes into play. Like if you're a boomer advisor, you may not trust Coinbase. Even you may not trust other exchanges. You may not trust doing it yourself, but you trust BlackRock, and you just like, well, they've looked at all this with all their lawyers. I trust it. So I'm a little in the same boat when it comes to some of these things, like that. The forks and all this, like I can't say I'm that native where I can explain it all, but I don't really see a problem with it. Again, the reputational damage would be brutal. Mm-hmm. They'd have to probably like make good on it.
So you alluded to this earlier, the anti-money laundering, but how will the authorized participants deal with AML considerations when they do Bitcoin transactions?
How will the authorized participants?
Yeah.
They're not touching Bitcoin. So that's the whole purpose. Here's what's going to happen. Let's say the price of the Bitcoin ETF goes above the fair value.
Yeah.
And AP is like, okay, there's more demand for the ETF. Let me step in and satisfy that demand. So they go to the issuer and say, I need more shares. And the issuer is going to, normally they'd say, give me the Bitcoin. But in this case, like, give me cash. So they just give them cash, get the shares of the ETF. They flood the market with that. They bought Bitcoin to hedge, and they pocket the difference. And that arbitrage happens all the time with any ETF. The difference here is they wouldn't collect Bitcoin to do the arb. They would collect cash, and they would get and when you do a creation in ETF, you do the creation at NAV. Yeah. That's why they would do the creation at NAV, sell in the open market here, and pocket that difference, and that would collapse the premium. So that's why the SEC didn't want in-kind creations. So the AP doesn't actually touch the Bitcoin.
So it's the issuer who's actually doing the transaction.
The issuer and Coinbase. So they work together. I believe they use the over-the-counter markets to get it, and that's where you saw some of the wallets updating and people reporting on like Grayscale's wallet and stuff like that. That's between the issuer and the custodian. And
so that's Coinbase doing the AML?
The what?
Coinbase is doing the AML check?
You mean at night just to check if it's there?
The money laundering.
Money laundering.
How do they money laundering and terrorist
AML.
financing and stuff?
What's that called? Anti-money laundering? Is that the acronym for that?
Yeah.
Again, like I'm a tourist to Planet Crypto, so the country of crypto. But look, this was asked of Matt Hogan, and again, this is somebody who's further into this, and he's like, well, look, they have insurance. They also are working with regulators to a degree and BlackRock to avoid that. But at the end of the day, I guess there's some risk that you could have some of that.
All right, let's move back toward ETFs and away from our crypto tourism, or at least in that direction. How have the spot Bitcoin ETFs been trading relative to their net asset values?
It's surprisingly good. So we're looking at like in Canada when they first started, they were like 1% away from the NAV, and we call that the arbitrage band because it's like how much does the price have to get away before an AP is like thinks it's worth it to intervene. Well, here they're only getting to 15 basis points. That's pretty good. You could say that is a cost. So you got to the 15 basis points kind of onto the expense ratio. But 15 either way is pretty good. I mean, for an exotic asset class like this, I'd say that's better than I thought. I thought it would take us a couple months to get here, but the U.S. market makers and APs are so good. They're so good at doing this, and they're in competition with each other. So I give them credit for that. So I was very happy to see those pretty low right off the bat. So again, though, with the cash creation, it's not that hard. You get cash, and then you put the Bitcoin in the open market. But they need that price to rise up or below to get them motivated. But there's so many of them that I think you'll see these premiums be tighter than other countries because there's just more market makers looking for like picking up pennies wherever they can find them.
So I've seen your tweets on this, Eric, but can you talk about the magnitude of the net flows into these Bitcoin ETFs?
Yeah, look, if you isolate the newborn 9 away from GBTC, anyone and their mother would be like, holy moly. I mean, it's literally the most successful launch of all time. I mean, let's say there's 20 stats you could use. This would be 15, it would be number 1 on 15 categories. Even the press attention, the flows, we're looking at, I think we're up to $7 billion in assets from the newborn 9. That's ridiculous for 2 weeks. Ridiculous. It never happens. And the volume's ridiculous. It's not just like one big investor put in $2 billion and then that's it, which happened to a couple ESG ETFs a few years back. This is real organic volume and growth. Where it all gets kind of weird is GBTC converted and it was an unlock, and they immediately saw a couple billion out, and they see 100 million or 2 every day now. But the newborn 9 have taken in about 1.5 billion more than GBTC has seen in outflows.
Wow.
So even if we isolate the 1.5 billion and we say, let's pretend a new Bitcoin ETF launched and it got 1.5 billion in 2 weeks, again, that's a big hit. That's more than Bitto had, and it's more than GLD had in 2 weeks. So I don't know what metric you would look at to think this sucks. The other thing is the GBTC outflows, people are saying, okay, it's 1.5 billion net. But I don't think you should compare it to all the GBTC outflows, because FTX was $1 billion and that money just left immediately. That's not really part of this. That's money that left. And then the people who arbed the discount, the prop desks, They weren't really Bitcoin people. They were arbing that and they're gone. So I'd say only a third of GBTC is actually money that is in play to go in the other ETFs, like people who are leaving to go to those. So you really should look at the net new demand as more like 4 billion of the 5, in my opinion, because the base of GBTC is complicated. A lot of that money came out just for non-investing reasons. It was a trade or a FTX legal thing. And so that's why this whole thing gets a little weird, is that. But it doesn't even matter. Even if it was flat, if it was like they offset, just wait. The momentum these things have early on is very positive. And you know, the BlackRock's got advertising campaigns. Larry Fink is out there saying this is a new asset class. Fidelity is involved. I mean, that's all you have to do, is just sort of trust behind these people who have strong reputations for successful products. Give it time. And these products already have 2 things that you need for foundational ETF category growth: volume and low fees. Those are the 2 most important things for the fish to come bite. So institutions like volume, advisors like low fees, and they each both like some of the other. They have both in spades. So the stage is set. The wholesalers are going to do their thing, and just wait. So anybody out there with the underwhelming take, I just think it's going to look like an idiot. My theory on that is the underwhelmers are one of 2 people. It's the Wenmoon degenerates who just can't wait a couple weeks. They just need like 10% every day. and they're not accounting the fact that Bitcoin went up 60% in the lead up to this, you kind of have to factor that into the whole thing. You're still up, 80% in a year, even with the sort of sell-off. You got to look at it that way. In this stock market, people front run the Fed all the time. It's normal, and they sell the Fed news. So that's part of it. The other thing is you got to maybe chill a little. You're up 80% even with the sell-off. You've doubled the Qs, and the Qs had its best year since the 90s. So there is a little bit of high expectations from some of the crypto people. They need to chill. Now on the flip side, you've got some of the more traditional finance people who really don't like Bitcoin. It's against their worldview. They don't like the crypto bros. They just don't like it. And I think they use the ETF launch. They think, I've got a little stick here to beat the crypto people over the head with. This will be fun. And they're like, this was underwhelming. This launch wasn't as good as people thought. Their motive is not pure. It's to troll crypto. The problem with that is that they're going to look like idiots in a couple months. I'm telling you, as somebody who's seen thousands of ETFs launch and has seen this industry defy odds all the time, the ETFs are powerful. They're disruptive. They gather assets. This is where all the fish are biting. All the advisors love ETFs. So the problem with them using the ETF stick is they're using the wrong stick. ETFs are going to prove them wrong. They should just come out and say, I hate crypto. Fine, that's a different argument. But to use the ETF as lack of success, you will be proven wrong. And in fact, again, all the data I said, I think you are wrong in 2 weeks. But just give it a couple months. They're going to look really dumb.
So you mentioned the difference between the newborn 9 and GBTC. Within the newborn 9, how are these ETFs trying to differentiate from each other?
Yeah, so the BlackRock's more like, look, it's okay now. It's safe. The bad millennials who wear shorts and can't run a business, they're gone. We're here. The adults have arrived. That's generally, it's access. It's safe. It's access. So it's a very clean message to the boomers and Gen X's. The smaller issuers are being a little edgier. They're saying we're crypto specialists, unlike these Wall Street opportunists. So they're each going to, I think, find their audience. There'll probably be some people who, one advisor we talked to on our podcast said he used Bitwise because they did donate some back. They were more crypto specialists. And he's a fan of BlackRock otherwise, so they peeled him off. ARK and Cathie Wood has been a bull for a long time. Some people might just reward her for being so bullish this whole time. Fidelity has a massive distribution, so I don't think they've done any advertising. They've got all these wealth managers all across America who manage boomer money, and so all they got to do is put a little of the portfolio into this, and they have flows just like that. So that's sort of how it'll play out. I think the marketing will be varying. I think the bigger the firm, the more conservative the marketing will get. Franklin went a little wild, putting laser eyes on Ben Franklin and stuff. That's a weird one. So the problem with that, I get it, it's fun, and I like the Twitter takeover. In general, these big companies need to lighten up. They have too many compliance officers. They're too afraid to say anything. Even their stock picker people, if you meet them in person, they're animated, they're cool, they can't say anything. They just need to lighten up in general. But the laser eyes, almost too far the other way, I think. The base of Franklin, just anyone who would think laser eyes are cool is going to get crypto on their own, already has it.
Right.
So I think BlackRock probably has the right approach, which is, look, our audience, you guys probably watched this from afar. You saw all these knuckleheads do all this weird stuff, but it kept coming back. It kept coming back, and you're intrigued. Well, if you're thinking about it, it's okay now. It's safe. We're here.
So are any of the newborn 9 really, leading the way with debt sales over the others?
Okay, so Fidelity and BlackRock are really neck and neck. They both are toying with $3 billion. And there's a little bit of a drop off. And then ARK and Bitwise are sort of real close in third, fourth place, respectively. And then, but even Invesco, Van Eck, they have over 100 million already. If any normal ETF that comes out and gets 100 million within 2 weeks is a blockbuster. So we've already have 6, 7 of them in blockbuster category. So even the ones that look like mid of the pack or mid are great. I mean, there's only one. I think only one is where I would call below profit level, which is Wisdom Tree at 13 million. But WisdomTree, they've got other things going on, and they have many products to subsidize this loss leader for a little while, and they're really into crypto, and they have products in Europe. So I don't think they'll close that. I think WisdomTree, they're just like, obviously wasn't a priority, or maybe they just thought, look, we're not going to spend, there's too many people in this race. But when our wholesalers go out to talk to clients and advisors, we just want to have our own product. We don't want to recommend Van Eck or BlackRock. We have our own. So I think WisdomTree, somebody asked me earlier in an interview, how many of these will be here next year? I think all 11. I think all 11. Now, what you could find is some wacky things come out that come in and close within a year. You could find something like carbon credits plus Bitcoin, or 2.2x leverage Bitcoin. They're going to throw a bunch of crap at the wall. Some of that will just fall instantly into the gutter. A couple things will make it, but my guess is these original 11 will be here in a year.
What do you think?
Oh, one more thing on that. BlackRock or Fidelity, there's only really room for one liquidity king. And they're both trading about $200-300 million a day. So it's interesting. Normally, the first one out is the liquidity king because they had their market for them. This is a race. So I've never seen a tie like this so close. I do think iShares probably edges out over the next year. I'll tell you why. Because Fidelity doesn't really have any big liquid ETFs. iShares has like 50 of them. And they're known amongst the trading crowd and the institutions. So I think their branding and work in this area will pay off in the end. And I think IBIT becomes like the big one with the most volume and the options activities around it. Not to say all the other ones can't be big, make money, and have a great life, but I think IBIT's probably 2-to-1 odds at this point, so the heavy favorite to be the liquid one, that if you're a pension plan and you need quick exposure, you would use that. Even if there's 5 bips cheaper, they're like, I don't care, the liquidity is most important to me.
You talked about earlier the benefits in general of ETFs. What do you think being allowed in an ETF wrapper does for Bitcoin?
Oh man, I mean, look, this is like, one of my metaphors is when the Beatles went on iTunes. The Beatles held off; they wouldn't go on iTunes for like 5 or 6 years as iTunes got popular. So younger people would not listen to the Beatles. I mean, it was that simple. They finally went on and all their albums went to number 1. I mean, it was like, just like that, everybody bought their albums. So this is a similar thing. I think it's just reversed. It's the older people who will think about buying it just because it's in an ETF wrapper. The SEC approved it. ETF's got a prospectus. They're all 100 pages, a lot of legal lawyers. BlackRock's trusted. That's what it means. It's now in a trusted environment. And ETFs to me are bridges. They're bridges from any world. And they're convenient. So they're convenient, they're cheap, they're easy to trade, they're on every exchange, they're convenient. I said that twice. Convenience is a very underrated benefit of ETFs. Any business, you make something convenient, people will buy it. I mean, there's single stock ETFs. Think about that. Like, that shouldn't sell, but one of them has over $1 billion. I'm just telling you, man. You make something just an inch more convenient, and people will buy it. Everybody's lazy. So I think in this case, you got the lazy factor, and this is really a pain in the ass to go do Bitcoin for most normal people. They just don't want any part of the wallet and all that stuff. So this is what that means. It puts Bitcoin into the preferred vehicle, and as Michael Saylor called it, the plumbing of the traditional finance world. And that is powerful. And the other thing is ETFs. You could say this thing about a mutual fund, but ETFs also they are hot. Every year they take in way more money than any other vehicle. They are like, Bitcoin and ETFs is interesting. ETFs are 30 years old, but they're both kind of hitting their stride, and they're both younger than most of the things around them. But ETFs, I think, have that mojo right now. They've got a lot of swagger. They are in the zone. And so it's not just that it's a vehicle you can get anywhere, because you can get mutual funds anywhere. Mutual funds are kind of dying. That's why I kind of go back to music. This is like getting your stuff on iTunes when all you had before were these other harder to get areas or vehicles.
So you mentioned Michael Saylor. Bitcoin's conception, like if you go and read the original Bitcoin paper, it was really an ideologically motivated currency that it expressed a certain worldview, which is sort of antithetical to, I don't know, an ETF, or at least it seems that way to me. How do you think the advent of spot Bitcoin ETFs affects Bitcoin's identity?
That's a really good question. I've been thinking about this because when the filings first came, especially BlackRock, I'd see in my comments like you could see it between people and within a person. There's the devil and angel. It's like number go up, yay Larry Fink. Then it's like, wait a second, do we really want to hand all over Bitcoin over to Larry Fink?
Right.
So I don't know, man. I'd almost turn over to you, but I do think that the mainstreamification of Bitcoin is probably necessary if you do want some growth on the price. The other thing is by getting it familiar with people. I was just on a podcast with Kathy Wood and a senator from Wyoming, and the senator was like, the ETF is going to get people more familiar, and then I'll get more like tailwind to make real regulation, and that will even help even more. So the ETF, I think, can jumpstart a lot of good things that will help it be a very consistent asset class. Now, the more it gets legitimized and mainstreamed, does it lose its appeal amongst those who like that it's punk rock and like that it's outside of the system and a little bit of a middle finger? I always thought if Bernie Sanders won, would Bitcoin be as big? Because, you get the same kind of politicians from both sides. Generally, a lot of things are run the same way, but Bernie was like, I want to upend everything. And Bitcoin's a little got that vibe, right? It's outside of the whole system. It's not like messing it up from the inside. It's like outside. Whereas you would say the current politicians are like, let's make incremental changes from the inside. And so to me, going into BlackRock and these companies is a little antithetical to that outsider thing. But again, if your goal is to have it grow and be legitimized and have a chance at being a currency, because a currency I don't think can be that volatile.
Right.
So this could also bring the volatility down if you have more people buying and holding, less more people into it. It could help with the volatility as it matures. So I don't know is the answer, but I will say when you see Larry Fink going on Fox and saying, I love this, by the way, he was like, he's being asked like what by Andrew Ross Sorkin, like what's the pitch here? He's like, if you don't trust your government. And I was like, whoa, this is crazy. So this is going to take us a couple years, and I think we're going to look back and go, how wild was that? Like those moments were like the early days of this whole thing, because, and then the same day you see a clip of Jamie Dimon calling it a pet rock, and that is just fascinating to me. That's why I spent so much of my mind on this, is because even though Bitcoin ETFs probably make up 1 to 2% of all ETF assets eventually, which is pretty good. We're talking 100 to 150 billion. I spent a lot of my mind on it because of the fascination factor is a 10 out of 10. I mean, it is so unique, and there's two worlds colliding, TradFi, DeFi, but also culturally. There's a cultural collide and a generational collide. And I feel as a Gen Xer, I'm generationally in between all of those worlds. And so it made me feel like I have an interesting vantage point to work on this. And James as well. He's a little younger. He's probably more into crypto. I'm like a little more boomerish. He's a little more crypto-ish. But the two of us together could go in between the worlds. And it's really interesting. And honestly, I think one of the things that I thought about the crypto world I liked so much was the people and the memeing and the sense of humor. And I really think that TradFi culturally could benefit a little, from this world. And obviously there's certainly things you could benefit from the blockchain, but just culturally and just learning the skepticism that younger people have for the 60-40, because I still love the 60-40. I think both worlds can learn from each other. I guess that's my point.
So who do you think is the biggest benefactor of this collision, as you describe it?
Well, if you own Bitcoin, you're probably one benefactor, right? Because an ETF is a portal, and through the portal, more people can buy it, and that should help long-term investors. That's one. Number two, I think the firms that put one out, they're going to have some revenue products. The BlackRock's case is a win-win for them. They're like, look, we can get a revenue generator, yet we can also disrupt, because we can say we're cheaper than Coinbase and we trade cheaper, and it's actually, we're disintermediating while making a little money. So that's a good opportunity for them. So I think the issuers would win for sure. market makers win a little. I think the system certainly wins a little here because to outsource this is a pain. Anytime you want to outsource something, the middlemen are going to make some money off of it. So the good news is compared to what FTX was doing, advertising, they had patches on baseball umpires and places they shouldn't even be advertising. There was like the NBA stadiums were being completely bought off by the crypto. And I was like, that's weird. You won't see that kind of like insane intermediary gouging. The ETF industry is clean and it's lean. So yes, these issuers make some money, but they're going to make a lot less than the SBF types who lost their minds and charged a ton as the middle people. These are professionally good middle people. They're going to do a better job. But in the end, the loser, in my opinion, is probably some of the crypto intermediaries, the Coinbase commissions. That said, Matt Hogan argues that because the ETF will bring in more people, the pie will grow in general, and Coinbase can do other businesses like custodian and whatnot. But so I think it's probably a mixed bag for them. But I do know if you have high commissions, you're in trouble. I mean, ETF trades at a 1 basis point spread. And with those, I think the expense ratio is really good. I thought it would take 2 or 3 years for the fee war to get it down to 25 basis points. I thought it'd be 50 right now. But that's amazing. And the ones on the market that we knew about in Canada, they're all over 1%.
Yeah.
BITO here was 95 basis points. GBTC was 2. So now you have a better version for 4 times cheaper. It's good. So even though I say the asset managers will win, it's not a lot of winning compared to some other areas of Wall Street that are just ridiculously, make so much money for what they do. This is a fair way to win, in my opinion.
Can you talk more? You mentioned the when moon people. Can you talk more about how the price impact of spot ETFs starting to trade compared to the predictions from the crypto community or some parts of the community?
Yeah, I mean, again, if your prediction on price doesn't include the run up,
right,
I can't talk to you. Like because there were some God candles on the way to the spot. Remember when the Cointelegraph intern said BlackRock's approved and that turned out to be a lie and it went up 5%?
Yeah.
It never went back down. Like it didn't go down because the rumor was so you got to count those little nice moments. You have to factor all that in and realize that hedge funds and traders thought, oh, this is an opportunity to buy a rumor and sell the news. So I think when you get rid of the selling the news, I don't know, in terms of price targets, there's a lot out there. I'll go with what we can predict, which is our flows. Flows are important because they're just pure money going in that wasn't there. Assets can go up or down because of flows plus market appreciation. So I don't know where assets will be. It'll depend on where Bitcoin is. But flows, there's been, we'll say, 1.5 billion net, and then total 7 billion into the newborn 9. So I'll just go with the 1.5. What net will we see by the end of the year? I'm saying 10 to 15 billion. Again, that's pretty good, especially relative to the size of Bitcoin.
Yeah.
But I just, that guy, Fred Krueger, who I like a lot, he just put something out saying that the newborn 9 are going to own more than MicroStrategy in like 3 days. Like it's that. So even though I say 10, that 10 to, everything's relative. The sign behind me is my book, Bogle Effect. That's about Vanguard. Vanguard takes in $15 billion like every couple weeks. So certainly 10 to 15 billion is big relative to Bitcoin, and it's going to help obviously because that's a lot of money. But in the scheme of all of Wall Street and all asset management, it's not that much money. Like I said, Vanguard takes in 200 to 400 billion a year. So 10 to 15 billion would be really great for that asset class, but not a tremendous amount.
Right.
So where will Bitcoin's price be? I don't know, because Bitcoin ETFs right now only own, even with GBTC, own 3-4% of all of Bitcoin. But that number is going to be interesting to watch. Where does that go? Does that get to 10%, 15, 20%? The higher it gets, the more it'll be interesting to watch this play out. Now, in stocks, ETFs own about 9% of the stock market. ETFs own 1.5% of gold above ground. They own about 5% of all bonds. So they're right around where they are gold bonds right now. If they double, triple, they go up to where they are stocks. Then at some point, they grow beyond where we're used to seeing them. That said, there's been a couple cases in ETFs where like an ETF would own a lot of one stock because of interesting dynamics. It happened with the Tanger factory outlet, was 50% owned by ETFs at one point. Even with that high ownership, the stock moved pretty independently of flows because other people trading it have an impact too. So I don't really see any point where the ETFs are like the tail wagging the dog of price. And I had to argue with a lot of the When Moon degenerates on Twitter because they were like, oh, dude, they came back to me like, dude, Mr. ETF man, you lied. I'm like, I didn't lie. I said they're going to be approved. In fact, I had it right. They're like, but why is the price down? I'm like, dude, ETFs were net buyers. They're $1.5 billion net buyers. It would have been worse without them. So
Right.
I told them, it's coming from your crowd, dude. I don't know who it is, but it's not the ETFs. They're actually contributed so far. And so that said,
Fascinating.
let's say they contributed $7 billion, the price could still go down. I'm telling you. We've seen this in the stocks. And they could also see outflows, the price goes up. There was a 2 or 3 days already where they had a negative daily. They like the newborn 9 token less than GBTC lost, and the Bitcoin went up just because GBTC's price was going down. So it seems like the market right now is riffing a little more off of GBTC's slowing than they are about the other dynamics. But that'll change. So that's why I think the market, there's just so many player types. I couldn't begin to predict the exact amount the ETFs will dictate that.
You mentioned Vanguard. What do you think of Vanguard's decision to not allow the spot Bitcoin ETFs on their platform?
It's on brand. Again, as somebody who wrote a book about them, Jack Bogle didn't really like commodities in general. He liked stocks and bonds because the money works for you. There's investment return. That said, Vanguard doesn't allow leverage ETFs to trade. They're like a family-friendly kind of, that's their thing. They're like, we have a rating system that we do all ETFs, and we based it off of movies. It's green, yellow, red. And green is the equivalent of a G or PG movie. Every Vanguard ETF is green, okay? A lot of issuers have yellow, like even BlackRock has some yellow, but like Vanguard and Schwab are the only pure rated G issuers. And so it's not a shocker. Now, they do allow gold to trade on their platform. So I did call them about this because like, well, gold's a commodity. And they said, well, Bitcoin has no use case. That's when they wrote that thing. And it was really a little bit of a middle finger to Bitcoin. Now, whether they're playing some offense to signal to older people, if you think this is all bull, come to us because we hate this too, maybe. I just think it was a very low risk decision because their base is just not going to be that into this. Now, I wouldn't do it if I were them. I'm a fan of Vanguard. I wrote a book about them. I think Bogle's great. I would have more faith in our own investors to make the right decision. I don't like the nanny state aspect of it, but it is on brand. And somebody said, oh, this is their Bud Light moment. And I said, no, it's not. First, they don't really care that. You're not going to impact Vanguard flows. I mean, It's just too big right now. But to me, it reminded me more of Walmart not carrying rap CDs in the late 80s. Like, remember Two Live Crew? It was not a good record, but because it was banned in Walmart and other big stores, it like went to number one because all kids my age were like, I have to hear what's on this thing. And so I think that being banned by Vanguard actually added a little more press. It kept the press cycle going, and it made it a little like rebellious. So it actually, I think, fit within Bitcoin's like outsider status, and it was a gift PR-wise, even though it seemed to piss most people off.
You mentioned your book on Vanguard and on Bogle. What do you think Bogle would think of Vanguard's decision to exclude Bitcoin?
Oh, he'd love it. He was asked about Bitcoin 2 years before he died. He said, avoid it like the plague. But remember, then he riffed right into commodities. It wasn't personal. He said, with a commodity, it's just what someone else will pay for it. With stocks and bonds, you get dividends, cash flow. There's more than just the price. There's actual cash flow being sent back to you from all the value getting created by a company. He was like, you're investing in a company, and a bond is an IOU, so you get a coupon. So he just didn't like the concept of commodity. Buffett was a little like that too. But, he's not everybody. A lot of people like the idea that you can have different things in your portfolio. I wrote a book on him, and look, Bogle didn't like half the Vanguard did. He didn't like their smart beta products. He didn't like value. He didn't like growth. He didn't like international. He said international sucks. You don't need it. Well, Vanguard is like the leader in international funds. So he would crap over all kinds of stuff Vanguard offered. So, join the club. I mean, he was savage towards everybody. He hated ETFs.
He did.
So, the fact that he said that is on brand for him. At the end of the day, he just came to this nirvana pure thing of just buy the total market index fund and wait 50 years. Everything else is distraction. It's almost like a Buddhist finding that perfect moment of nirvana. But most people are just not built like that or wired like that. And so I acknowledge all that in my book.
How do you
But
think?
honestly, what would have made his head blow off more is the GameStop. So this would have been less bad than that. That he really would have, his head would have exploded, I think.
Yeah, that's funny. How do you think we'll see financial advisors use spot Bitcoin ETFs in client portfolios?
Yeah, so this is, I think, as hot sauce. So I think the portfolios have changed. Used to be you chase the 5-star manager in the 90s, like the Fidelity, like Peter Lynch. But then Peter Lynch fell out of favor, and you go, oh, I need to go to a new one. And you'd constantly kind of go in between hot managers. And that was your whole investing. Now, Vanguard killed all that. Now people buy low-cost index funds for their core. 60-40, you can get the whole thing for 4 basis points. It's beautiful. So, but it's boring. You got to wait 30 years as the compound. So people get bored. So I think that the advisors and retail will use this in what I call the hot sauce bucket, which is stuff that is very different than what you already have in your core. This is where ARK lives. This is where thematic ETFs live. This is where Robinhood account lives, stock trading. I think Bitcoin lives there. It's something to make sure you don't have FOMO later. It's something to give you a little, make your, give you a little shiver from time to time, because like the 60-40, again, you are expecting 7-8% a year annually. It's, there's just not that much to talk about, and you got to wait a long time. So I think Bitcoin is perfect to complement Vanguard. So even though Bogle would have hated this, and he wrote a whole book about how Cathie Wood type funds are awful, and they'd shooting stars. They'd come up and then come down. And so, but I wrote a piece saying Cathie Wood's survivability is because Bogle actually won. Because the more the core gets boring, the more people want some stuff to have fun with on the top, and they won't sell it. Because if they have all the serious covered in the core, there's no pressure. So you could have more diamond hands actually in the Bitcoin. So if it has a bad run, well, okay, fine. It's down 30%, but it's not the main thing. So to me, this is the perfect way to do it. And if the hot sauce occupies you enough that you don't touch the 60-40 so it can mature and compound over 30 years, then it's actually done a behavioral service to you. So I'm a fan of hot sauce. It's viable. The flows show things to go either dirt cheap or shiny objects. To me, that's where it lives. Other people will say more serious things like a lower Sharpe ratio, it's an alternative, but I just don't think it can enter alternative status quite yet. It's too volatile. It makes gold look like a money market fund. But I have no problem. You guys, I mean, I tell Cathie this. I'm like, Cathie, just say you sell different brands of hot sauce. Because she's like, the index fund is dead. Who wants to invest in all those dumb companies? And I'm like, you should. No one is going to agree with that because they're not going to put their kids' education on your fund. So I actually tell her, just be like, hey, look, we have 99% active share to the index. Use us to complement your other thing, just in case we're right. Some of these stocks could go out 10 baggers. Bitcoin should consider, that's how I think it's going to be seen. And if people are smart, pitched. And the reason that's smart is that the advisor probably can't get fired. You 1 or 2%, even if it all goes to it's, again, you still have that nice core. So when I talk to the crypto people, I try to explain, you're not going to take over the 60-40, and you probably shouldn't. Because they're all in. I'm like, wait, you're all in crypto? Like, it's your whole savings? And they're like, yeah. I'm like, so then I'll try to explain why stock and bonds make sense, but I don't know if I'm having any difference. That's why I tell you, go between the two worlds. But I see it as a 1 to 2%, like Tabasco sauce.
Tabasco. Bitcoin as Tabasco. Love it. Lots of great insights, Eric. Thanks a lot. This has been a really fantastic conversation.
Yeah, thank you for having me.
Yeah, great. Thanks, Eric. Great to finally meet you.
Likewise.